Hi, this is Jack Miller. I want to make this little video on what uh, a loan loss reserve is, or accounting for loan loss reserve, or allowance for loan loss reserve. And I'm making it from a real estate lending perspective, but it really is on any type of lending perspective. This can be a technical issue. I'm just going to try to keep it fairly simple, just to give people the basic understanding. Self-understood, they should speak to the regulator if they're in a regulator industry, related industry, their auditing firm if they get audited books, and their lenders if they borrow money, because they're probably going to want to make them keep an allowance reserve. So first of all, an allowance for loan losses is usually used in the accrual method of accounting as opposed to the cash method of accounting. Again, I don't want to get too deep into it, but the cash method of accounting is cash in, cash out. Accrual method is when something happens. So if you're owed money, you would book on the accrual basis, you would book it the day it's owed, not the day the money comes in. If you contract for something or you incur a bill on a Monday, on the accrual method, you'd book that on a Monday, not when you paid the bill. Google accrual and accounting and you'll get it. I don't want to go into it now. But you can do an allowance for loan loss even if you're in a cash method. And I really want to focus on the allowance. So effectively, an allowance for loan loss, what that effectively is you as a lender are trying to predict what your losses are going to be on a loan, even before you anticipate the loss or before you even make the loan. And it's traditionally booked when you close the loan, and then it's updated periodically or as things happen. So, and it's developed over time and depending on the risk of the loan. So if you have a portfolio, for example, of unsecured loans, your loan loss allowance is going to, or on a percentage basis, is going to be much bigger than secured loans. The more secured the deal is, the less likelihood the loss, the less you will incur it, and the less the allowance will be. But I'll start at the beginning. So again, what you're trying to do in the pure sense is predict any losses that you'll have on a deal or a portfolio and account for them as early as possible, really as soon as you book the loan, not when the loss is incurred. So in a pure sense, and this is how I would explain it to someone non-technical, let's say you own a local store and every day a kid comes in and is going to steal a Milky Way bar, and that sells for $1, whatever it is. Well, that in the beginning of the day, you know today that next Tuesday someone's going to come in and steal that $1 item, so you have to prepare for it. You build that in to your profile and your accounting, and you raise the price of everything else by a penny or 2 pennies or whatever it is, because that kid's going to steal that candy bar. So it's the same thing with lending. If you're charging someone, let's just say a 10% rate, and sooner or later you're going to have a loss, you're really not charging them a 10% rate. You're charging them a 10% rate, but the net effective rate to you may be 9.5, maybe 9 3/4, but less than 10. So you want to account for that now. So give you just a basic formula for it. Let's say you're going to say that you're going to use a 1% loss ratio and nothing changes. Just 1%. So if you book a loan for $100,000, you're going to day one take a $1,000 charge and build your loan loss reserve by $1,000. And if nothing changes and you keep it that way, it stays at $1,000. And when the loan pays off, you take that $1,000 into income. Remember, you're taking it as a loss day one. So really, you're building up a cushion. In fact, when big banks do this all the time, the regulators make them do it, and they should be doing it. So give you an example, when COVID hit, big banks, the huge big banks, they took billions and billions, maybe hundreds of billions of dollars, a charge as soon as COVID hit. So it negatively impacted their earnings. So they had this reserve. And what happened is, in this particular case, a lot of the charges weren't taken into reality because the loans performed better than expected. So they released that money slowly into earnings. So it really, it accelerated the losses and it accelerated the earnings. That's really not supposed to happen, and it's really supposed to even out. And that's the point of the accrual method. It evens out the highs and evens out the lows. But let's say, for example, you make a loan for $100,000, and let's just say you come up with a 1% a loan loss allowance. You take $100,000 out of income, you put it in reserve. Remember, it's a bookkeeping entry. It's not tax. It's not a tax deferral. You can't use it for the IRS. Again, I'm not an accountant. Speak to your accountant, but I'm pretty sure about that. And let's say things are going smooth. You just leave it at that $1,000. But let's say, for example, something happens. Real estate goes down in value, or the borrower loses a job, or there's a higher likelihood that you're going to have a loss on that. You may want to, when you know there's going to be a loss, increase that reserve to 2,000 or 3,000 or 4,000, or you have to figure out what you're going to increase that reserve. But you should increase that reserve to what you think the loss may be. Now, the loss, the reserves are determined by typically historical performance on a portfolio. If you have a portfolio that's well seasoned, or you're a company in business for a while, you know what the losses are. Some of the things, and we don't really do this currently, but when we used to be bank financed and had audited statements and this and regulated, we needed to do this. And we had, I think it was 12 or 14 points that we used to take into consideration to determine the reserve. The loan to value was one. Believe it or not, the location is one. The borrower's experience, the borrower's credit, the type of property. There's all kinds of things, and you have to build your own statistical model into it to determine what the future losses might be. It doesn't mean it's going to be, but the reality is, if you're investing in a lot of loans, even if you're a passive investor, it's foolhardily to think that you're not going to have a loss sooner or later. So all you're trying to do is predict how much that loss may be and account for it at the right time. Now, I forget who said, I think it was Warren Buffett said, a rising tide hides who's naked in the ocean, or some crazy quote like that, but it's a good quote. We're sitting here in 2022. In the past 10 years or so, we've had almost no losses. In fact, the reality is we've only had one loss, and it was a freak thing. It happened about a week or two ago on a loan. So we've had a lot of loans close and pay off with no losses. But the reality is a good economy has done that. But just because a good economy has done that in the past, you need to be prepared for reality. And the reality is, when you're getting a higher rate and you're taking risk, there's going to be losses. Now, everyone does things to mitigate the losses. What we do is we focus on the collateral. We focus on things like that to mitigate the losses, and we keep low loan to value so we won't have losses. But there still may be losses. And my point is not whether there's losses, whether there's not losses, is the accounting of it. So again, what you want to do is you want to figure out what amount you want to keep in a loan loss reserve. It's a bookkeeping entry. It's a reserve on it. It comes off income. It's a reserve on your balance sheet that when you need it, it comes out of reserve, so it doesn't hit your income then. So effectively, that's the broad brush of what loan loss reserves are. Some people revisit this periodically, whether it be quarterly, semi-annually, annually, or when you know about something. But it's a good idea. What we used to do is do it on a quarterly basis, and then as something comes up with a specific borrower or the economy in general, to adjust them. I'm a big believer in having a loan loss reserve, even if you're a cash basis, even if you're well secured, because things happen in life. And when you have a reserve, it's easier to digest it when the bitter pill comes. And sometimes bitter pills come when you least expect it. So I think I've given you the essential of what loan loss reserves is, loan loss reserve accounting, allowance for loan loss reserve. If you're a bank, self-understood, federal regulators make you have this. If you have bank lines, usually your lending institution is going to make you have it. Usually if you get audited statements, they're going to make you have it. It's just good business practice to have it. So my advice to private lenders, even if none of the above apply, I would set up an internal reserve, even if it's a half a point a loan, a point a loan. If you're getting an 11% yield or a 10% yield, take a point off the top and effectively put that in a reserve. Again, it's a bookkeeping entry. It's a mental entry. Put that in a reserve. So if a loss happens, you're dealing with it sort of as you do your books, as opposed to when the loss happens. So that's the scoop. I think I hopefully I tried not to give you to drive you too crazy on this. There's a lot of FASB's and accounting pronouncements on this. It's heavily dealt with in the accounting standards, and from a regulatory perspective, you can deal with it as complicated as you want, or you can keep it simple. My advice, if you're not regulated and you don't have to keep it very simple. It's good business practice. We do it. I know this area very well. I've lived with it for most of my entire adult life, through good times and bad times, and I've seen the swings in them. And it's a complicated issue. I'm trying to dummy it down for YouTube, and just to get people thinking about it and to understand what an allowance for loan loss is. And it's good common sense practice. Subscribe to the channel if you want more information. If you like it, like it. If you don't like it, you can leave a negative comment. That's fine. Leave your comments. I'll try to answer them if I can. But remember, I'm not an accountant. Speak to an accountant about the details of it. But I think I gave you a good broad brush overview. Take care and have a wonderful day.